Retirement bucket strategy, how to build a retirement paycheck from your investments. So we're going to talk about this. I did a video on this exact thing about a year and a half ago, maybe even 2 years ago now. My man Fritz Gilbert, who had written this book, just recently wrote it, and it's coming out in May, Keys to a Successful Retirement, link in the show notes. And I interviewed Fritz just last week on the YouTube channel with a Q&A. So we've had him on the show twice now. Big fan of Fritz, and a good guy. He actually reached out to me when I did a video presentation of this article. So let's go back into it. It's been, like I said, probably been going on 2 years since I read it last, because he had written it October 2016. So, and this is by far his most read blog post. I think he said over 60,000 people have viewed this. So I want to read it because I think it's important, and I don't really remember exactly what I said about it last time. I don't think I said that much negative, or else he would never reach out to me. But I'm a fan of the bucket strategy, my friends. I always have been. The problem with the 3-bucket strategy is just, in my experience, it's tougher for it's just tougher to manage. No other way around it. From a keep it simple perspective, 2 buckets, the barbell is easier than 3. But I do like the 3 buckets. So let's dive into it. All right. Again, dateline October 2016. The same thing is applicable here today. For decades, now, and remember too, by the way, is that Fritz is he just retired a year and a half ago or something like that. Yeah, he just got off Cobra. So he is doing this. He's literally doing this with his building a retirement paycheck from his investments. So he knows from what he speaks. For decades, you've been diligently saving and building a nest egg to ensure that you have a shot at maintaining an acceptable level of retirement. Acceptable lifestyle in retirement. Once your working years are over, the focus becomes on how to generate a retirement income, or in other words, how to build a retirement paycheck. Moving from an accumulation phase to a withdrawal phase is one of the most significant financial changes that comes in retirement. Unfortunately, there's much less written on how to generate an income in retirement than on the accumulation phase. Could not agree more. How do I build? How do I build? How do I build? Well, now it's how do I tear down? How do I distribute? Today, we'll address the withdrawal phase, outlining a strategy I'll be using in my retirement. How to build right here. So the bucket strategy. A common approach to setting your investments up for withdrawal phase is to establish a bucket strategy. Originally conceived by financial planning guru Harold Evensky for a video of him. Okay, so here's a video of him discussing the link. Even though I'm still several, and he's not, so Fritz said, even though I'm still several years from retirement, I've already been working on setting this up. And actually, Fritz is now in retirement. Actually just wrote one, how to manage the bucket strategy. All right, so bucket 1 is the cash bucket. The cash bucket should be fully liquid, risk-free, and readily available. Depending on your risk tolerance, you should be able to fill bucket up 1 with anywhere between 1 to 3 years of spending requirements not covered with other income. Your goal here is not to generate a high return, but rather to protect your spending requirements over the next few years. To avoid sequence risk, having to sell stocks during a downturn like what we're going through right now, get your bucket filled prior to retirement date. Could not agree with that more. I could not agree with that more. Don't wait to retirement to sell stocks to fill up your bucket. Because if you retired, like I've had a number of people reach out to me the last couple of months, they just retired. Now they're fine because they have pensions, but man, if you had to sell stocks to put in your bucket, you don't want to do that. As a more conservative investor, I'm targeting 3 years of spending in bucket 1. Why? Well, from 1966 to 2009, it's taken the S&P 500 3 years on average to return to its pre-crash high. You want some sufficient cash in bucket 1 to ride out a bear market. I could not agree more. I think that's spot on. Absolutely. Good on you, Fritz. Before retiring, ensure you have sufficient assets to cover your annual spending with a safe withdrawal rate of 4% or less. He's going to be targeting 3% as retirement. I just completely disagree with that. And look, Fritz he can do whatever he wants. I don't care. I find the whole 4% rule to drives me crazy, as you well know. And I find a 3% rule to drive me crazy times 2. But look, whatever you got to do. I'm not getting too much of that here. Maybe I will. All right, so I'm not here to challenge Fritz. I'm not. I'm just, people got to do what they got to do. Just remember, the 4% rule is premised, now the 3% rule, on the idea you're going to spend, if you have $100,000, you're going to take 4% out $4,000, and you're going to increase that expenditures each and every year with inflation. The problem is there's no evidence of that linear expenditure. There's none whatsoever. The evidence is the exact opposite. That it'll start like here, maybe go up a little bit, but then it'll drop significantly too, by the way. Now, that might not be the case for you. Some people say, but how about healthcare? The vast majority of us aren't going to have any significant expense in healthcare. It's just not going to happen. Now, some people do. There's always an outlier for sure. The reason why the healthcare numbers are so skewed is basically about 5% of the people are the ones who cost the biggest expense. If you look at anything for health care, you recognize there's a few, the outliers, who skew the average significantly. That's a fact. Now, if you're in one of those outliers, you're hating life. The vast majority of us, or of you, I don't know, I might be in that, won't be though. And because that, even that though, the 4% rule is not sufficient enough anyway. If that was you got a significant expenditure for healthcare and retirement, the 4% rule isn't going to save your bacon, just not. Having no mortgage will, for sure. But anyway, the 4% rule, again, assumes, or 3% rule, it doesn't matter. It assumes a straight and linear rate of expenditures each and every year adjusted with inflation. And there's just no evidence of that whatsoever, none. And on top of that, it just says that is the maximum you can take out without ever running out of money, essentially. Was it 60% S&P 500 stocks, 40% intermediate treasury bonds? I mean, look, okay. So, and it's not even that. I just the whole thing is based on a flawed premise on the expenditure part. Secondly, okay, so you don't run out of money. I mean, but now you lived like a pauper on the fun part of your retirement in order to make sure that you didn't run out of money when you're 93 years old. I just don't do that, man. All right, so let's just say you spend a little bit more than you should have in the first 10 years of your retirement, 10 to 15 years. Hey, you might never live to past 75, 80. You might not, though. I mean, a lot of people die. B, even if you do, are you still going to be spending the same amount of money you did when you're 65 and freshly mint retiree? No. And C, all right, what if you spend less when you're 75 years old? Sometimes you just got to tighten your belt. It sucks, but the way I look at it is don't spend. Don't be frugal on the front part, so that way you can be less frugal when you're 88 years old. Vociferously don't agree with that. Michael Kitces, I think it was him, some guru. They looked at the numbers. They say the average, you took 6% a year on average, you'd be fine. And what that meant is, I think it was like half the time you ran out of money, half the time you survived, something like that. But it's like you could take average of 6% a year on your portfolio, which is 50% more than the 4% rule, and 50% of the time you still had money. All right. So the way I look at it is like, look, if you can take 4%, you never run out of money. 6%, only 50% of the time you run out of money. I use the 5% rule. So let's take 5%. 5%. All right. 75% or so of the times you are successful. 25% of the time you're not. Well, that's assuming you live for 30 years anyway. That's a pretty broad assumption to make. I don't think it's legit. And it's assuming still that your expenditures go up each and every year with inflation. I don't think that's legit either. So anyway, all right, let's keep going. Let's go back here and move myself down. All right. Let's see. To ensure you stay within your safe withdrawal rate, set up at least 1 year of your cash bucket in a separate account, then establish an automatically monthly or bi-weekly transfer from that account into your checking account. Once it's in place, you've established a retirement paycheck. I think it's freaking spot on, man. Every 2 weeks, you got money going in. You don't have to think about it. And bucket 2 is the income bucket, which has a goal of generating income with controlled risk. Since you'll be using the funds in this bucket to periodically refill bucket 1, you want to keep a focus on stability. However, to ensure your investments are producing results and keeping up with inflation, you have to take some risk. While bucket 1 is no risk, no return, you can look at bucket 2 as some risk, some return. Investments in bucket 2 should focus on high-quality fixed income, bonds, REITs, real estate investment trust, a smaller complement of stable dividend-paying stocks. I'm not a fan of that. I don't think any stock should be in that second bucket, but be it as it may. Other high-yield securities, MLP, I'm not a fan of that either. Balanced mutual funds, I don't know, man. I think bucket 2 should be nothing but, I don't have any problem with REITs, that's for sure. Maybe utility stocks would be the extent that I would go. I don't, because utilities are a commodity. I mean, literally nowadays utilities are a commodity. But even that, I'm sketchy of having that in bucket 2. REITs, high yield bonds, maybe. longer term, yeah, sure. I'm just not a big fan of this bucket at all. I just don't think it's worth it. Not worth the risk because you're not getting any gains. You're not getting enough gains for the risk, in my opinion. But anyway, he's using Vanguard's Wellesley fund. Yeah, and that's 30%, 35% stocks, 65% corporate bonds, and I think there are some government bonds in there too. Yeah, I could see that being the second bucket. The first bucket is cash, CDs at the bank. Second bucket, Wellesley. I'd be comfortable with that. But Josh, you just said no stocks like J&J. Yeah, I know, but you're not running it. If you had the stock and J&J was it, and it fell to zero, you're doomed, man. At least with Wellesley, you got a bunch of holdings in there that can offset some of the significant drawbacks of owning individual stocks. I would not have the Vanguard Dividend Growth Fund, which I own, by the way, in bucket two. No way. I just completely disagree with that. But hey, that's the fun thing about this stuff. We can disagree and still be buddies. Nothing wrong with that. If you're very conservative, consider this advice from Daryl Kirkpatrick and aim for 10 years of spending between cash and bonds. Yeah, that's too much. I don't agree with that at all. So, but I don't think that's the way to go. But be that as it may, if I agree, if you're conservative, that would be a guide for you for sure. Several times per year, I'll target quarter ends, look for any asset class which has performed well, and sell portions of those investments to refill the cash in bucket one. If, more accurately, when we enter a major bear market, draw down the levels for bucket one for 1 or 2 years and allow time for your riskier assets to rebound. Yep. Alternatively, you can divert your dividend and interest earnings from bucket 2 and 3 as a steady stream of cash into bucket 1. Completely agree. 100%. I think that's all great. I think of the dividend diversion as a drip refill strategy and plan on using that in my retirement. I love it. So basically saying, look, if I'm getting a $5 dividend payout from Wellesley, I'm putting that $5 in my bucket 1. I got no qualm with that. My preference is not to do that because I think not reinvesting dividends really hurts you for the growth side of things. But I think that's a good strategy. I got no qualm with that at all. With the longest time frame, you shouldn't have to tap the money in bucket 3 for around 10 years or so. Therefore, it's focused to generate the long-term returns possible through stocks. Only stocks have demonstrated an ability to consistently outpace inflation. In fact, according to this MedFavor research, stocks have earned 5% over inflation in the past 10 years compared to 2% for bonds and 1% for T-bills and cash. This bucket will have swings in value as the stock market does its normal thing. Since you don't need to worry about assessing the money for 10 years, you can sleep at night through the next bear market knowing that things will most likely recover before you need to tap into stash. I could not agree more. Long-term investments capture the real returns only available through stocks while avoiding losses during bear markets. Stocks, junk bonds, commodities. I on the bucket 3, I think 10 years is too long. I think should be 7 years. But anyway, either way, on bucket 3, I don't think you should be sending the dividend payments to bucket 1. I think that's not a good move. I think you should reinvest for sure. Because you want to get the growth on the dividend reinvesting, especially on a down market. A down market is great. That's dollar cost averaging, man. Like we just got hit 35%. I think they pay the dividend. I got to look at when they paid the last dividend. I can't remember. But anyway, they just paid the dividend most likely for dividend paying stocks. Hold on, let's see. Hold on a second. Let's look at it. There's a Vanguard Dividend Growth Fund, which I own. So disclosure, I own it. Let's see. This risk performance holdings profile. Let's go to data. Do they just pay a dividend? Let's see. Oops. Let's go to historical prices. Dividends only. Apply. Yeah, March 27th. So they just paid a 2-cent dividend. There you go. So that, so again, you want that money. So if on March 27th, they paid a 2-cent dividend. Let's look at prices on March 27th. Historical, yeah, right there, prices. There we go. So on March 27th, it paid a dividend, and the stock was down to $25.56. It paid that $2, 2-cent dividend, $2.07 dividend, 2.7-cent dividend, and then on top of that, the market fell as well. So it dropped in price on that day. Is at $25.56. Which is down from 31 roughly. We'll just say 32. So it had dropped from 32 to 25. So that means you're 32 minus 25 divided by 32. That means it's down 22%. So that dividend right there, the 2 cents, roughly 3-cent dividend, actually bought you shares that were off 22% from its high from just a few weeks before. And so that's what dollar cost averaging can do when you're reinvesting dividends. So that's pretty good. Now it did flounder a little bit more, but then now it's up to, so you bought it at 25.56. Traded at 24.96 because the dividend was called when it pays out dividend, you drop the value of the shares, and now it's at 27.18. So now it's up 27.18 minus 25.56 divided by 25. So now it's up 6.3 cents percent since you bought that dividend. So it's worked out great. So I'm a fan. Let's look at Wellesley, BWEINX. Wellesley Income Fund. Let's see what this did. I'm sure that paid a dividend too. Oops. So what did this do? This paid a 18, roughly 19-cent dividend on March 20th. All right, so prices on March 20th. Let's take a look at Wellesley. Prices on March 20th were down to 23.56, which is off. Look at 20, think 28, 28, 28. Nope. Nothing at 28. Nope. So nothing at 28. So 23.56 was off. Not that much. 27.14, 27.81. Say 27.81 to 23.56. 27.81 minus 23.56 divided by 27.81. So this was down 15%. Wow, even the Wellesley was down 15%. And then you're gotten a dividend at almost 19 cents a share that bought shares at 23.56. Not too shabby, man. Now it's back up to 26.15. So, man, there you go. Let's just look at the profile. Let's look at the chart. Yeah, look at that. 2803. Yep, there you go. 2803 to 2298. 2803 minus 2296 divided by 2803. It's down 18%. Even the Wellesley Income Fund is down 18%. That's crazy. Let's go back to my man here. How to implement, he's at it. All right, we got this. So I'll let you all read this. But look, I like that. I'm a fan. So basically, I mean, I like the bucket strategy. I just think the 3-1's a little bit. Now, Fritz is different. I mean, he likes this stuff. I don't. It bores me. I just like set it, forget it, be done with it, look at it once a year. But a guy who enjoys this, I mean, Fritz is selling puts and stuff, so he's into this. So he's more hands-on than I ever wanted to be. That's for sure. And that's cool, man. But if you're not as hands-on, the 2-bucket strategy, in my opinion, works better. 3 to 5 years cash, the rest in Vanguard Total Stock Index Fund. Be done. I literally could not be any simpler. But no, I think you'll like this. Read the article, buy his book, link in the show notes, and we'll see you next time. Thanks.